Hi everyone, welcome to Natural Rubber Market Outlook. This is episode number 26. Let us start this session by having a review of the prices during the previous week. So we have a short PowerPoint presentation here, only 3 slides only. When we look into the futures markets, on this screen, left side is showing the futures markets. During the week ended July 8, Shanghai rubber futures average 0.5% lower compared to a week before. SICOM, the benchmark grade TSR20, averaged 1.0% lower compared to a week before. Japan benchmark grade RSS3 December contracts averaged 1.8% lower. So this is a summary of the futures market. Coming to physical markets, we can see only negative signs on the extreme right column. STR20 Bangkok averaged 0.8% lower. SMR20 Kuala Lumpur averaged 0.5% lower. RSS3 Bangkok averaged 2.1% lower. RSS4 Kottayam in India averaged 0.4% lower. Latex Bangkok averaged 2.4% lower, and Latex Kuala Lumpur averaged 6.3% lower. This is a summary of the prices during the last week. So last week in my market outlook, I gave an outlook which is positive. Means I told that prices would be going up, but subject to 3 conditions. The 3 conditions were: 1, the global economic recession fear is not growing further. Number 2, China's COVID situation is not resurfacing again, and also dollar remaining steady. Unfortunately, the scenario were different. That means whatever conditions we assumed did not happen, or whatever risk factors we pointed out, that really happened. So risk we have pointed out actually happened. So because of that, prices could not gain, and prices fell down during last week compared to a week before. Just now we'll have a quick look into the market sentiment. How is the market as of now? We will go to the next slide. So this slide is showing what is the sentiment in the market as of now. Global recession fear is dominating market sentiment world over. This is not specific to natural rubber market. This is specific to equities and commodities. So let us have a quick look into the various points, various factors which are contributing to the negative market sentiment. Number 1, as I mentioned before, the risk of a global economic recession is growing, is a looming large. And last week you have seen that the recession fear is outweighing the positive sentiment arising from the major easing of COVID lockdowns in China. So last week we have expected that prices could gain because of the major easing of COVID lockdown in China. But unfortunately, the growing risk of the global economic recession outweighed the positive sentiment arising from China's COVID lockdowns. That was one important factor. In fact, this single factor is at the moment dominating market sentiment, not only rubber, all commodities as well as equities. This single factor is dominating at the moment, and this single factor is expected to dominate market sentiment not only in the short term, but for a long time. Maybe this may continue till the second half of next year. This is what economists feel as of now. Second important factor, the minutes of the Federal Reserve, US Federal Reserve's Federal Open Market Committee meeting came out last week, and the minutes reveal aggressive policy agenda of the Federal Reserve. That means Federal Reserve is, according to the minutes, minutes reflected that Federal Reserve will go ahead with its aggressive policy rate hike in its forthcoming meeting in July. That means the US Federal Reserve's minutes gave a confirmation that Federal Reserve is going ahead with its aggressive interest rate hike agenda. Third point, last week we have seen dollar continuing along a strengthening path. Dollar strengthening was during last week was contributed by two factors. Number one, potential further rate hike by the Federal Reserve, that is making dollar more dearer. Number two, dollar is a safe haven currency. So whenever there are risk and uncertainty in the global economy, dollar will gain strength because fund managers will shift from risky asset classes to dollar. So it is called a safe haven currency. So the aggravating global economic recession fear generated additional new demand for safe haven dollar, and that also contributed to dollar strengthening. So a stronger dollar is not favorable or not a favorable condition for natural rubber market, not only for natural rubber market, for the equities as well as for the other commodities. When the dollar is stronger, that is, the investors will be finding the return on investment less attractive. So this is a disincentive for them to go for buy. Another major development we have seen last week was the plummeting of or major fall in crude oil markets. Crude oil prices tumbled last week on fear that the imminent global recession, global economic recession, can potentially erode the oil demands. So last week we have seen Brent crude oil falling below $100 in the intraday trading. Of course, they closed more than $100, but in intraday, certain hours within the trading day, Brent crude oil came down even $100. So taking the going into the Brent crude oil markets, Brent crude oil was rolling $129 around 1 month ago. That means on 8th of June, Brent crude oil was rolling $129 per barrel. From that level, Brent crude oil came down nearly 17% within just 1 month to the level of $107. That is a rate on 10th of July. So this fall in oil price is despite the factors currently impacting on the supply. There are two important factors are impacting the supply. One is the supply outage in Libya, and the other is supply disruption caused by the oil workers strike in Norway. So despite this supply disruption, oil price came down because players in the oil industry believe that oil price will come down because of oil demand will come down because of the global economic recession. And also we have seen last week analysts reported that oil price can come down to the level of $85 per barrel by the end of this year. Already we are in July, within 5 months oil price can come down to the level of $85. And also by the end of next year, 2023 December, oil price can come down to the level of $65 per barrel. So all these forecasts also came out last week. So that also impacted how the oil price, when oil price comes down. So that is a message to the commodity market, because oil has a dominance, it's a major weightage in the commodity basket. when the oil price comes down, commodities are expected to fall down because of the dominant weight enjoyed by oil in the commodity basket. So whenever oil is seeing a downfall, correspondingly all commodities are expected to fall. Then another negative development in the market was China reimposed the containment measures in several parts of the country. So this was in response to the increase in the newly infected cases in China. In fact, China lifted most of the restrictions on 28th of June. So that gave some immediate positive market sentiment. But because of the resurfacing of COVID cases in several parts, and also the massive testing and some of the containment measures introduced by the government, actually investors fear that China may not go along with China may not lift the remaining restrictions, or China at any moment authorities can reintroduce the restrictions in major economic hubs. And another major development in the natural rubber market that is specific to the JPX Osaka RSS3 futures is the Japanese yen sharp appreciation. The assassination of Japanese former Prime Minister Abe resulted a sudden jump in the demand for safe haven yen. Like dollar, Japanese yen is another currency, which is considered as a safe haven. Means whenever there is an uncertainty, people will leave risky asset classes and they will buy Japanese yen. So because Japanese yen is considered as a safe haven currency. So the assassination of Japanese former Prime Minister resulted in a sudden jump in the demand for safe haven yen. And whenever yen is stronger, a stronger yen means JPX RSS3 futures are less attractive. It is more expensive to overseas investors, or otherwise it is less attractive. So that created a negative pressure on the JPX futures. So this is a summary of what happened last week. What happened last week, all these factors are remaining. There is no change. That means a recession fear is there, and the Federal Reserve's aggressive policy rate hike is there. Dollar is continuing its strengthening phase is there. Oil price is expected to come down, and China situation, COVID situation, there is not much, nothing much to cheer about because cases are there, and also the situation in Japan may prevailing situation in Japan may it can help Japanese yen to stay stronger. So means all these unfavorable conditions are likely to stay in the short term. So with these points in mind, let us go to the final slide. So what we can expect? So short-term direction of NR prices. What lessons or what information, what observation we can draw on the short-term direction of natural rubber prices? Natural rubber markets could not sustain the positive sentiment generated in an immediate response to the major easing of COVID lockdowns in China, effective from 28th of June. The reasons, I'm summarizing what I have explained before. 4 reasons. 1, why natural rubber market could not sustain the momentum. 4 reasons. 1, the more dominant negative influence of growing recession fear. Downswing in oil prices, major downswings in oil prices, resurfacing of epidemic cases, COVID cases in China, and 4th reason, dollar's continued strengthening. So all these factors are remaining. So in view of the growing fear of global recession, that is a more dominant factor among the four. So NR market lacks the energy or the fuel to gain in the short term. That means conditions prevailing in the not only in rubber market, equity markets and commodity market in general are not favorable for a recovery in rubber prices in the short term. In fact, that doesn't mean that rubber prices will not go up. It can go up, but with a short margin. It cannot make major recovery because the sentiments are dominated by the fear of a global economic recession. So in the short term, natural rubber market will be dominated by the global economic recession. A global economic recession means demand outlook will be lower than expected earlier. Demand for natural rubber heavily depends on the state of the global economy. When we are foreseeing a recession, correspondingly, we have to foresee a downside in the case of natural rubber demand. So the demand outlook is not favorable because of the growing fear of the global recession. That's all. Thank you very much. We will see you again next week at the same time.